So it is my pleasure to introduce Dr. Pill. It's difficult, perhaps, to design a CV more appropriate for the role he now holds, or for speaking to such an audience as this, than the one he's accumulated over many years in policy, private sector and academia. In terms of institutional experience, a CV featuring Oxford, Stanford, Harvard, and various policy and private institutions is a good start. But the substance of Dr. Pill's experience while at these institutions makes him even more suited to these challenging times. So as the title of our conference suggests, the world of central banking is in flux. But of course, the past can be some guide to the best way forward. Dr. Pill has produced well-published academic research on financial liberalization, fiscal rectitude, or the lack thereof, and is a specialist on the functioning of money markets, the money transmission, and central bank mandates, all topics that are in stark focus today. As we heard yesterday, the interactions between monetary and fiscal policy have become tighter in recent times, at least in some people's eyes. And having a policymaker with such a firm grasp of the breadth of issues involved is a boon for the bank and, of course, the wider central banking community. The nuts and bolts of the first steps of the transmission mechanism have gone from being fringe back-office discussions to being front and center of monetary policy communications. The ability to communicate policy in this new environment is key. Where the old textbook monetary policy is out of the window, the previously unconventional is now very conventional, and where engagement with financial markets, especially as some central banks unwind their balance sheets, is at the heart of policy concerns. Dr. Pill's experience here in the public and private sector and knowledge of, say, Target 2 intricacies are very timely. Indeed, with an eye on our CBDC panel later today, it's also a real advantage that as payments technologies innovation is a pressing topic, we have an economist who is as comfortable discussing abstract policy topics as he is the plumbing details. Certainly, as central banker's central banker, it's my pleasure to welcome Dr. Pill to the stage.
Thanks. So good morning, everyone. Let me just put my slides up. How do I do that? Here we go. So, good morning, everyone. It's a great pleasure to be here to speak at King's College and the Qatar Centre this morning, and I'd like very much to thank the organisers of the conference for their invitation and their hospitality. So I thought I should start by explaining the title of my speech. So the first part, which is English, I think is pretty self-explanatory. It's neither obscure nor very original, but it is very important. Returning inflation to target is where I'm going to focus the bulk of my comments this morning. The second part of the title, which is in Welsh, requires a little more explanation. It's a nod to our hosts and my nationality, and indeed the nationality of Rhys as well, who just introduced me. For the first time since 1958, Wales have qualified for the Football World Cup, which of course will be held in Qatar this year. So there's a connection there. During that qualification process, Welsh football fans have embraced Davin Ewan's folk song, Yma o Hyd, as their kind of theme. This was a song originally written as a tribute to the resilience of the Welsh language over the centuries, and its anthemic chorus states, and I don't know if there are any Welsh speakers here, so I will not, as a non-Welsh speaker, I won't offend you, so I'll only report in translation. The anthemic chorus states, "In spite of everyone and everything, we are still here." Now that might sound a little bit melodramatic in a sporting context, but for someone who's lived through the trials and tribulations of various Welsh qualifying campaigns for international football tournaments over the last few decades, it actually captures the roller coaster psychology of that experience pretty well. But now that Wales have finally qualified for the World Cup and brought 64 years of pain to an end, perhaps it's time for Welsh fans to pass that song on to another constituency. And of course, I have one to recommend: central bankers. Because surely if there's a group that needs to show the persistence, the patience, and above all, the perseverance necessary to achieve its goals in the face of adverse circumstances at the moment, it's today's monetary policy makers. as an MPC member, I'm not here to seek your sympathy in the face of those challenges. Rather, I hope to convince you that, in spite of everyone and everything, we on the MPC are still here, and in the face of those challenges, we will deliver inflation back to its 2% target. So in my remarks today, I aim to make 3 points. First, I want to emphasize the MP's focus is on returning inflation to that 2% target. Second, I want to recall the drivers of recent inflation developments and how they've shaped the MPC's policy actions. And third, I want to restate and unpack the MPC's most recent communication about the outlook for monetary policy decisions. So working through these 3 points has the character of peeling an onion, progressively working from the most visible public comments towards more detailed technical or detailed arguments. And I hope each of the different audiences that I seek to address today, not all of which are in this room, from the wider public through the media and market participants to the experts attending this conference, can find some layer of that onion that speaks to them. So let me start with some broader comments aimed at the wider public. Given today's high level of inflation, it is time for plain speaking. In recent talks, I've offered more detailed discussions of the mechanics of monetary policy on topics like quantitative tightening, activism, and portfolio balance effects. But today I want to speak, at least for the moment, more directly, more simply, perhaps more bluntly. That's not to deny the complexity of the challenges the MPC faces and the finely balanced character of the decisions it has to take. We've entered a new phase for monetary policy. Risks to the economic outlook are two-sided. As the Governor has said on several occasions, the MPC has to navigate a narrow path in managing these risks. On the one hand, ensuring that the current elevated level of headline inflation does not become embedded in inflation expectations and price-setting behavior. And on the other hand, weighing against the current squeeze on real incomes that threatens to create slack in the economy and downside risks to inflation further out. I anticipate that we'll have time to discuss these complexities in the QA that will follow, and I hope to leave plenty of time for that. But first I want to reiterate the commitment I gave in my first interview on joining the MPC last autumn. I see my role as an MPC member as being in the price stability business. That means returning inflation to the 2% target in a sustainable way. If there's one message that the wider public audience should take away from my remarks this morning, it is that. Returning inflation to 2% is at the heart of the MPC's actions over the past 10 months. Ceasing asset purchases, starting to raise bank rate, beginning to shrink the asset portfolio. All these actions serve to tighten monetary conditions and weigh against inflationary pressures. Of course, there's always a question of whether these actions should have come earlier or been more aggressive. In assessing those claims, we need to be wary of hindsight bias, and we need to recognize the benefits of adopting a measured, determined, and purposeful approach to the transition from the very accommodative policies introduced during the global financial crisis and maintained more or less ever since. But now that the initial stage of that transition has been successfully navigated, an immediate issue for monetary policymakers is whether the pace of policy tightening now needs to change. In May, inflation reached 9.1%. The MPC forecasts, as you can see on this slide, a further rise to around 11% later in the year, once rises in international commodity prices stemming from Russia's invasion of Ukraine pass through to UK utility and food prices. For an MPC member charged with achieving the inflation target of 2%, someone in the price stability business, if you like, this is obviously a very unsatisfactory situation. But that discomfort pales in comparison with the challenges facing those most directly exposed to the current cost of living crisis. For those who spend a high proportion of their income on energy and food, unfortunately, a group particularly numerous amongst the less well-off, recent price rises have imposed a significant squeeze on their real incomes. These are obviously difficult times for many people. Our current experience is therefore a salutary reminder of the importance of price stability. It reminds us why having the MPC in the price stability business remains so crucial. It explains why bringing inflation back down to target is essential so as to reduce the uncertainties facing households and allow firms to plan for the future. Achieving price stability serves as an anchor for wider macroeconomic stability and prosperity. The institutional framework for monetary policy here in the UK, an independent central bank held to account for its pursuit of an explicit inflation target, is in place. For the first time in its 25-year history, that framework is being put to the test in an inflationary global environment. We have to meet that test successfully. Achieving the 2% inflation target is now more important than ever. In the MPC, we have both the tools we need and, perhaps more importantly, the resolve it will take to restore price stability. And even in the face of current challenges, I'm confident that we will succeed. So let me turn a little bit more to the more detailed debate. If that commitment is as strong as I claim, it begs the question of how we've ended up in the current situation with inflation so uncomfortably high. Answering that question requires that we delve a little further into recent economic developments, peeling back another layer from the onion. So let me turn to the question of what's caused the recent jump in inflation. In large part, recent price developments have been driven by a succession of unanticipated external disturbances to the UK economy. Among others, the COVID-19 pandemic and its aftermath, and the Russian invasion of Ukraine. In the jargon of economics, we label this a sequence of adverse external shocks. I think 4 features of these disturbances are worth emphasizing this morning. First, they were genuinely shocks in a specific technical sense. They were not, and perhaps more importantly, could not have been anticipated. Second, they've transmitted into UK inflation relatively quickly. Just for a moment, I'll focus on the impact of higher international oil and gas prices on consumer price inflation. The direct implications of these external shocks for UK price developments transmit within a matter of months, even with the added complications created by this off-gem price cap mechanism that we all unfortunately know a little more than we wanted to about now. Higher European wholesale gas prices entered UK utility prices, and thus UK CPI inflation that we target, within half a year. Moreover, many of the subsequent indirect implications of higher international energy prices, that's to say, their impact on a wider set of UK goods and services prices via, say, higher transport or utility costs, are already also being felt. These indirect effects account for part of the widening incidence of above-target inflation developments across a broad set of core goods and service components of the overall index. Third, these shocks have been large. Again, it's useful to use energy prices as an example. Looking at the daily data, from its trough in May 2020 at 8 pence per therm, spot UK natural gas prices have risen to above 500 pence per therm in the immediate aftermath of the invasion of Ukraine. Taking a somewhat wider perspective, we've seen wholesale European gas prices rise by more than 300% over the past year, while electricity prices have risen by 30% and oil prices by 50% over the same period. And indeed, as you can see a little bit in this chart, wholesale gas prices have surged again in recent days. Fourth characteristic of the shock I want to emphasize is that since the UK is a net importer of goods and energy, these large increases in international goods and energy prices represent a deterioration in the UK terms of trade. Simply put, the goods that the UK buys from the rest of the world have become more expensive relative to the services it sells. Other things equal, this will weigh on the international purchasing power of UK residents. In practice, we anticipate a squeeze on UK household incomes, which will constrain domestic spending and demand, and threatens to open up a margin of slack in the UK economy and eventually lead to higher unemployment. So it's not just UK inflation that's been affected by these large external price shocks, but also UK incomes, spending, and potentially employment too. The four nature characters of these shocks that I've described has important implications for monetary policy. It's a famous dictum that monetary policy affects inflation with long and variable lags. While these lags are difficult to predict and likely to vary across time in concert with the broader state of the economy, we typically think that monetary policy actions taken today will have their maximum impact on inflation at a horizon of 18 to 24 months. By implication, monetary policy cannot entirely offset the impact of external price shocks on UK inflation. And attempting to do so may serve to add to rather than contain inflation volatility. As we've seen, as I've just said, higher energy prices feed through to CPI inflation within a matter of months via both direct and indirect effects. If a rise in international oil or gas prices is a genuine shock, in other words, it couldn't have been anticipated, then even an immediate monetary policy response would not be able to offset its initial impact on UK inflation. The offset would only feed through as the lags in policy transmission unwind. As a result, even very active employment of UK monetary policy cannot prevent the emergence of some short-term volatility in UK CPI inflation. And what's more, given the uncertainty surrounding both the lags in monetary policy transmission and the direction and magnitude of further external price shocks, the danger exists that attempts to fine-tune inflation developments using monetary policy become a source of volatility in themselves. Policy actions may turn out to be ill-timed or miscalibrated in the face of these uncertainties. There's thus an inevitable short-term volatility in UK inflation, which monetary policymakers have to live with. And when the shocks that drive short-term volatility are large, as they have been, then the amplitude of this short-term volatility inflation will also be large. This story remains an important part of the explanation for what the UK has experienced of late. Recognizing the impossibility of fine-tuning inflation developments on a month-to-month basis, the MPC has long emphasized its focus on achieving the inflation target over the medium term. This medium-term orientation of monetary policy is crucial if the inflation target is to be met in a sustainable manner, and monetary policy is not to become a source of inflation volatility itself. At present, the desirability of adopting this medium-term orientation is bolstered by the nature of the underlying drivers of UK inflation. The large rises in the prices of international goods and energy not only directly raise UK inflation, but also weigh on domestic incomes and demand through the terms of trade channel. As a result, in taking monetary policy decisions today, the MPC needs to take account not just of the immediate inflationary impact of higher energy prices in the coming months, but also the potential disinflationary impact of higher energy prices through these weakening of incomes and demand at longer horizons. Weighing up these two forces is central to the baseline projections published by the MPC in May, and the framework defines the difficult, narrow path that I mentioned earlier, which the MPC has to navigate over its forthcoming meetings. Further complications for monetary policy stem from tightness in the labour market and the strength of corporate pricing power, at least in some sectors. The tight labour market owes largely to weakness in labour supply rather than the strength of labour demand. UK GDP is still only slightly above pre-pandemic levels, despite unemployment rates falling back to the low levels seen ahead of the lockdowns. It's higher rates of inactivity amongst UK workers following the pandemic on account of early retirement and a rise in long-term sickness, as well as the impact of Brexit on the flexibility, cost and availability of EU workers, which appear to have weighed on labour supply. So with vacancies and hiring still strong, nominal wage growth in this tight labour market environment has risen to levels above those usually deemed consistent with achieving the inflation target. And in parallel, firms are trying to re-establish their profit margins. As consumer demand weakens, corporate pricing power is becoming more concentrated in the business-to-business sector. Supply chains continue to be disrupted owing to the fallout from the pandemic and the invasion of Ukraine. But for each firm that reports difficulty in obtaining components necessary for production, there's a supplier facing strong demand with significant pricing power in that supply chain and the ability to pass higher costs along the value chain. It's in this context that we see that one way of viewing the interaction between external price shocks and domestic price, wage, and labour cost pressures would be to see the two stories as additive. In that case, UK inflation is high, both because of the direct and indirect impact of higher international energy and good prices, and because of the impetus to domestic inflation imparted by the strength of wage growth and corporate efforts to re-establish profit margins. But an alternative and perhaps more worrying view would characterize the impact of the two drivers of UK inflation as multiplicative. The strength of corporate pricing power, the tightness of the UK labour market, and the real income squeeze on UK households all make it more likely that the impact of higher international goods and energy prices will extend beyond their direct and indirect effects that I've already mentioned and translate into second-round effects in wage, cost, and price setting. In other words, UK price setters and wage bargainers will try to offset the impact of higher headline inflation on their real spending power by seeking higher profit margins or higher wages in order to preserve their real incomes. Crucially, this threatens to create more persistent inflation dynamics in the UK, which continue even after the original impetus from external sources has dissipated or even reversed. It's via such second-round effects that higher current inflation can become embedded in the inflation process and achieve a self-sustaining momentum all of its own. Such behavior would threaten a more sustained deviation of inflation from target, going beyond the realization of this shorter-term volatility, that inevitable shorter-term volatility that I already mentioned. So to emphasize, because the inflation implications of second-round effects are more persistent, they're more relevant to the pursuit of the inflation target over the medium term. But for the same reason, they're more amenable to influence by monetary policy actions that operate through these long and variable lags. So by nature, it's the persistent inflation dynamics will continue even while the lags in monetary policy transmission unwind over time. And the difficulty of timing monetary policy actions precisely that I mentioned is less onerous when addressing these more persistent and thus lower frequency developments in inflation. So these are the reasons why the MPC has tended to place more weight on the evolution of domestic price and wage setting in assessing UK inflation. It's not because it's a domestic component, even though it is, but it's because it's a persistent component of inflation, which matters much more in in achieving the inflation target sustainably. So having already discussed some of the key considerations governing my assessment of the policy outlook, I'll conclude with a few remarks on MPC communication, centered around the statement published in the aftermath of the June meeting. This represents yet another peeling of a layer off the onion I mentioned. In both the media and among market participants, there's a cottage industry seeking to interpret central bank statements, and I've been part, as Rhys said, of that industry in the past. Those still working there don't need to worry. I'm not about to put them out of business, and I'm certainly not going to pre-announce my MPC vote for August today. But of course, there'll always be attempts to interpret any central bank communication for clues about the policy outlook. That's both inevitable and indeed sought after by policymakers. After all, what would be the point of making statements if you hope they'll be ignored? But I'd caution those interpreting such statements against reading them slowly through the lens of so-called forward guidance about the immediate outlook for interest rate decisions. As I've said in the past, I'm skeptical of forward guidance as a tool for central bank communication and policy, at least when it's understood as providing a definitive view of the short-term interest rate outlook. If you like, what's sometimes called forward guidance with a capital F and a capital G. On my reading of the evidence across jurisdictions, experience of using such forward guidance is at best mixed. On occasion, it started well, but almost uniformly, it's eventually ended in some confusion. At a time when policy rates were stuck at their absorbing effective lower bound, a case for forward guidance could be made on the grounds that it allowed for further monetary easing by flattening the forward interest rate curve when the conventional approach of lowering bank rate was no longer available. But, at least for the present, that case no longer holds, now that rates have risen, now actually quite comfortably, into positive territory. If policy easing were to be required, bank rate could be raised more slowly than currently anticipated, or even reduced if necessary. Forward guidance can also help contain interest rate volatility while policy is uncertain. As central banks were making the difficult transition away from the very accommodative policy settings first established in the face of the global financial crisis and maintained more or less ever since, a case could be made that forward guidance, capital F, capital G, has helped to ease and support that shift. It's on that basis that I, somewhat reluctantly, acquiesced in the further tightening language embodied in MP statements through the turn of the year. But now, asset purchases have ceased, bank rate has risen, the QE asset portfolio is shrinking, and gilt sales are under consideration. The transition from one phase of monetary policy is better established and better understood. As a result, the case for maintaining forward guidance to smooth the transition is, at least in my view, much diminished. So on this basis, the further tightening forward guidance language that's been in place in MPC statements since last November, despite its evolution over the intervening months, has come to outlive its usefulness. So speaking from the collective perspective of the MPC, using forward guidance of that form requires near unanimity across members of the committee if it is to be meaningful. But as the patterns of individual votes on bank rate in recent months has revealed, unanimity about the short-term interest rate outlook no longer exists. We shouldn't be defensive about that. One of the strengths of the MPC setup is its individual accountability and the diversity of view that encourages. At a time when inflation is elevated, monetary policy faces substantial challenges, and uncertainties heightened by geopolitical and epidemiological concerns, it would not only be surprising, but also worrying if all MPC members moved in lockstep. For all the commentary about groupthink on the committee, I see little evidence of that either in our internal discussions or in our published votes. but trying to shoehorn that necessary and constructive diversity of opinion into a common statement is understandably and probably inevitably confusing. It's certainly hard to encompass the prevailing diversity of opinion into a short and clear statement of forward guidance, capital F, capital G. And if, in that context, attempts at guidance create more confusion rather than more clarity, then surely the time has come to retire them. Taking a more personal point of view, there are several reasons why I supported the move to our new form of communication in June. In particular, the further tightening language previously employed could not be maintained indefinitely, at least not without taking the ultimately indefensible position that the level of interest rates did not matter. More generally, I repeat, such guidance is a trap, attractive at the outset, but difficult to exit from gracefully. Moving to a new form of language without the capital F, capital G forward guidance reflects that reality. So where we have ended up is captured in the language on this slide. So to conclude, I'm just going to offer a few observations on this language from my perspective. First, by focusing on the scale, pace, and timing of further changes in bank rate, the statement clearly widens discussion beyond the interest rate decision at the next meeting. In my view, this represents the desirable introduction of greater flexibility into our communication about the policy outlook when compared with the previous language. It thus reflects the uncertainties we face and the likelihood that we will have to take finely balanced decisions over rates, not just in August, but also beyond that, in the front of these two-sided risks to the economic outlook over the next year that I've discussed. Second, by referring to any further increases in bank rate, the introduction of this greater flexibility has not obscured that the next change in bank rate is more likely to be in one direction than another. We're talking about rate increases, not rate decreases. Although I admit at the same time, by saying any increases, we do allow for the possibility of rates remaining on hold, which, at least given some of the votes we've seen from the committee over recent times, is something that couldn't be ruled out. Third, the statement also gives an indication of how the MPC intends to respond to future developments. In line with the argumentation I've already offered, it emphasizes that the MPC will be focused on indications of more persistent inflationary pressures, which, in my view, places emphasis on identifying potential second-round effects in wage and price-setting behavior. This language has helped to clarify how the MPC defines its policy reaction function at present, prioritizing more persistent trends in inflation over the headline spot measure. Fourth, by signaling preparedness to, if necessary, act forcefully in response to indications of greater inflation persistence, the statement reflects my willingness to adopt a faster pace of tightening than implemented thus far in this rate cycle, while simultaneously emphasizing the conditionality of any such change in pace on the flow of new data and analysis. Much remains to be resolved before we vote on our August policy decision, and how I vote on that occasion will be determined by the data that we see over the coming weeks and my interpretation of it. And finally, fifth point, harking back to my opening section of my remarks, the statement places, in red on the slide, a direct and clear emphasis on the MPC's commitment to return inflation to target at its heart. This is something all MPC members agree on, and it's the main message addressees of the statement should extract. As I said earlier, it's also the message I would like all of you here in the room, in the media and financial markets, and among the general public to take from my comments today. Ama Ohid, the MPC is still here, and in spite of everyone, and everything, we will return inflation to target. Thank you very much.
Diolch yn fawr am eich araith ddiddorol iawn.
I won't try and respond in kind.
Thank you very much for your interesting speech. I must point out that David Aikman also is Welsh, so we're coming for you. A very interesting speech. I have a question of my own quickly, but before that, maybe people could put their hands up and I can take down some names for questions. Gulchen. Hannah, David. Fascinating. I think the message came through. You're in the price stability business, and I assume that's somewhat reflected in the simplification and just getting back to basics about what you're aiming for and the language we see there. So it seems to be quite a lot about anchoring inflation expectations in some sense. Do you identify that with second round effects? The second round effects to me is a somewhat distinct concept. You spoke a lot about cost pass-through, which I think of as second-round effects. I assume you're not simply monitoring wage pressures and cost pressures. What are you looking at in terms of inflation expectations, and how does that fit into these second-round effects, as you call them?
Well, I think you identify a pretty key point, and I think it's a key point of focus of the committee. And to be frank, it's a key point of different views within the committee. This diversity of opinion that I've mentioned. And I think people in this room who've worked on looking at monetary policy in emerging markets will probably, back in the day of the 80s and the 90s, stabilization programs, will probably be able to engage in this. I mean, there's one view of the inflation process puts a big emphasis on second round effects being a sort of catch-up. So we see realized inflation, and then wage, cost, price setters are all trying to catch up to restore margins, restore real wages, and so forth. And that's essentially a sort of backward-looking process, because today's spot inflation, which we're trying to cap up with, is a reflection of price developments over the last 12 months. So if that's what's driving behavior, as headline inflation comes off, and as you saw from our forecast, we expect it to peak towards the end of this year and then come off, then you expect that pressure to sort of catch up will diminish, because headline inflation is itself diminishing. So that's sort of a backward-looking form of second-round effect. And that doesn't put a big weight on inflation expectations. In fact, it sort of assumes that inflation expectations remain well anchored over the medium term, which is at the very heart of the inflation targeting strategy that we have. But there's an inevitable pass through the economic system of this external price shock that works itself also through domestic wage and cost pressures, a kind of pipeline story, if you like. The alternative interpretation of what we're seeing is that those developments in wage, price, and cost behavior, margin behavior, are actually forward-looking. And there is a concern about whether they are becoming de-anchored from the inflation target. And of course, if that's the case, then that would be much more worrying from a monetary policy point of view, because it would suggest that we are moving away from the anchor that the inflation target provides. So I think there's kind of two policy implications of that. The first policy implication, which you've already identified, I think we've seen that in various forms of speeches and other comments from members of the MPC and others over the last few weeks, is that we are emphasizing, rightly in my opinion, and hopefully strongly, I've tried to be strong about it today, is that we will do what is needed in order to bring inflation back to target, in order to stabilize and emphasize the commitment to that as the anchor to the whole system. And I think we are still there. We still believe that we have inflation expectation anchored, and we will monitor this process of the pipeline effects, the passing through, to ensure that what we're seeing is consistent with this more backward-looking view of how second-round effects are operating, and is not seeping into this more forward-looking view, which would create concerns about the anchoring over the medium term.
And apart from monitoring, say wages, what else are you particularly focusing on when you're checking for this anchoring?
Right. Well, I mean, wages are important, but they're not the only thing. We are very fortunate in the bank, and thanks to efforts of some of the people in this room, we have a very rich set of information that we collect. We do a number of surveys, both surveys looking into the labour market, into the household sector, but crucially also into the corporate sector. And we're supported in that actually with other surveys that have been done by ONS and others, including private sector surveys. So one of the surveys that I think plays quite a big role in our thinking right now is this decision maker panel survey that the bank has done. And that asks very direct questions for a very broad set of companies about how they see their input costs, the price of what their inputs are, how that's evolving, how they're seeking to price in terms of outputs, and implicitly, as a result, what pricing power they have in trying to re-establish their margins. And I think where we are right now, as I went into perhaps more detail than was required in what I said, is trying to understand how that margin behavior works is pretty key in understanding where we think inflation is going to go. The sort of bigger picture here is, owing to these adverse terms of trade shocks, the squeeze on real incomes and so forth, we are expecting the economy to slow. We're not expecting really to see any growth in the economy over the next year or so. And ultimately, we are expecting, or forecasting at least in the forecast we published in May, to see unemployment rise. I mean, this will create the slack that weighs on the inflationary pressure. Not all of that slack is being created by monetary policy actions. A lot of it is slack that's created as a consequence of the real income squeeze coming from these external shocks. But nonetheless, that slack will itself weigh on the inflationary dynamics. So in that environment, the key question is, we are already seeing evidence of consumer demand in the economy weakening. Consumer surveys have turned down quite aggressively, and as a result, we anticipate seeing consumer-facing businesses seeing less demand, having less pricing power, and their ability to raise prices being diminished. But a sort of key open question in all of this is whether business-facing businesses, so firms within the supply chain, we hear a lot about the disruptions in the supply chain, the difficulties of getting components. And what I was trying to hint at earlier is, for every firm that's saying we have difficulty getting our components, there's a supplier of that components that feels like it's facing strong demand and has a lot of pricing power. And so it's within that business stability, within the supply chain, that we think that this kind of margin cost pressure can emerge. So sort of key question in that context is how quickly and how extensively that diminishing of consumer demand, which is already influencing consumer-facing businesses, work its way back through the supply chain, as hopefully the supply disruptions which are operating in the opposite direction also ease as the pandemic and the impact of the invasions recede.
Interesting. Hanno, you had your hand up earlier. I think there's a microphone coming. There we are.
Can you hear me? Okay. Well, this was very informative. Thanks for giving an interesting overview of the drivers of inflation. One thing you didn't mention in your overview was sort of the role of real interest rates. As you know, right now, especially at the short end of the maturity spectrum, the implied real interest rates are really deeply negative, not just here in the UK, but also in the Eurozone and in the US. And I was wondering if you could comment on what kind of role that plays, if any, in the inflation dynamics, and also how you would judge when these real rates have sort of returned to a level that you think is appropriate.
Do you want me to take a few, or
We can do whatever you want.
sure? Gulshan.
Thank you. Gülçin Özkan, King's Business School. I would like to ask about the fiscal side of things. How much do you worry about the potential for public debt burden, given the unprecedented debt to GDP levels, in addition to what might happen to the aggregate output?
You had a question, I believe.
getting your steps there, Sorrely. Thank you. My question is going to be very similar to Hanno's, actually. So if you took like a naive Taylor rule perspective on where rates should be, you'd be hundreds of basis points north of the current position. So I guess my question in a high-level sense is, like, do you think you're stimulating the economy or contracting the economy with the current stance of policy?
Okay, so those are good questions. I think they're not necessarily very easy questions, but I wasn't expecting to have easy questions. Maybe the easiest answer I can give to a very difficult question is on the fiscal side. So, I mean, it probably won't surprise you that I'm not going to make big statements about fiscal policy. I mean, I wouldn't have done that anyway, but in specific circumstances, I'm even less likely to do it. So I'm not going to make big statements about that. I mean, I think it is key to say that, you know, through QE, the bank and other central banks around the world have become engaged in holding and the issues of public debt in ways that go much more extensive than was the case 20 years ago. But I think it's also important to say, speaking from the perspective of the MPC, that we are making decisions on rates and on our asset portfolio focused exclusively on achieving our objective. So we are going to do what we need to do in order to get inflation back to target using the tools at our disposal, which are setting bank rate and managing the portfolio of assets that we have as a result of the quantitative easing program. And we're not going to be deflected from that objective, that channel, through fiscal concerns. It's for others sitting in other parts of town to deal with the fiscal issues. So then on the two questions around, I mean, I could couch them in terms of, you know, R star and so forth. You know, R star famously is a difficult thing to estimate. It's a thing, even a difficult thing to know what it is, let alone how to estimate it. And I'm skeptical that we either know enough or agree enough to have that as a useful real-time indicator of monetary policy. So I don't want to sort of engage in a discussion of saying, oh, we're a bit above or we're a bit below or so forth and so on. I think that's almost impossible to know in real time. What I will say, though, is that, you know, when we look back at this with the benefit of long hindsight and we're looking at it in a historical context, we will see whether we were more or less stimulatory. I think the big picture for me is that we've spent most of the last 15 years in an environment following the global financial crisis where monetary policy was in a very supportive mode, right? So interest rates were floored at the effective lower bound. They were pushed into this absorbing state. And as a result of that, when it came to the need for more easing, we moved into a quantitative easing framework, which, you know, was more by force of circumstances rather than desire, because I think there were lots of good reasons not to get involved in fiscal issues indirectly through holding large amounts of public debt. But anyway, we got there, and that was in a world where, in the aftermath of the financial crisis, through the fallout from the Brexit referendum, in the early stages of the pandemic, in the European sovereign crisis, there was downside pressures on activity, there were stresses in the financial system, and above all, there were downside risks to price developments, so below the inflation target. So monetary policy should be easy, was easy, and there was no real trade-off being faced there, right? On all dimensions that you might think about, crucially including the key focus of achieving price stability, but also on supporting activity and supporting the functioning of the financial system, it was all in one direction. I mean, I think what we're seeing now is we're moving to a very different phase of policy. This is what I mean by we're facing two-sided risks. And it's important why I try to emphasize that the nature of the external shocks to the UK economy that we've seen over the last year are trade-off inducing shocks. They've tended to push inflation up directly, but they've also tended to weigh on real income and demand, and so pushing down activity and threatening downside risks to inflation at longer horizons. The MPC's forecast, published in May, has inflation below target at the 3-year horizon, right? That's something which is often missed in the current debate. Now, whether that's a good forecast or a bad forecast, we can debate, but I mean, there's a lot of smart people in the bank who are producing that forecast. So I guess my point is that we're trying to manage our way in a lot of uncertainty and balancing these two-sided risks. And I think what we've been doing is, in this purposeful way, focused on our target, withdrawing that monetary accommodation, making a transition to what should be and normalization of policy, moving to having to move at least to a tighter monetary policy and maybe even a restrictive monetary policy. But there's an element of experimentation in doing that, right? We will know with the benefit of hindsight, considerable hindsight, whether we were above or below R star. But in real time, we're always going to be saying, do we need to do more in order to contain short-term inflationary pressures and ensure that we get back to target sustainably over the medium term? So that sounds like I'm avoiding your question, but what I think it's trying to do is describe what at least I see we are doing, which is I don't have a concept of there's a Taylor rule number out there or there's an R star number out there. We need to jump to it. We need to jump above it in order, right? Because I just don't know what that number is. But what I do know is relative to where we've been, we need to be tightening. We have tightened. I think we probably need to tighten further. And the key question now is the pace at which we're going to go from here.
Questions? Questions, please. George? Sorry, there's a mic, so just behind you.
It's a bit of a follow-up to the question of risk, but perhaps more from a statistical point of view. Do you think that inflation persistence has increased or decreased compared to previous instances of big shocks? And the second question is, in trying to figure that out, do you see any role for models in putting together all the various factors you have in mind, or do you think we're just in a very uncharted territory and you just need to use judgment instead?
At the back, I can't quite see who it is, so please identify yourself when. Oh, it's Ben. In the middle at the back row. Thank you.
Can you hear me?
Yep.
I think I'm right that the mortgage stock has become more fixed in the last 5 years. So in the context of your long and variable lags, does that suggest a change in the sort of target horizon for inflation, or does it mean that you're more minded to move in larger increments in the near term? Thank you.
And actually, I have one question myself. I think I read recently, it may have been you making the comment, I think it was certainly coming out of the Bank of England. There was a comment comparing the fact that the bank had started raising earlier and more gradually relative to, say, the Fed later and dramatic. How do you, in your own mind, regardless of whether or not either of those paths is correct, how do you think of the effect of like a slow, gradual increase versus, a rapid one, starting from now when the effects might begin to happen? Because I think I saw that comment, maybe from the speech of yours.
Yeah. So the questions haven't got easier as we progressed, I have to say, and those are all very good questions, but also I think quite challenging questions. So to George, I think the question you're asking is like at the heart of the policy debate. So what I was trying to say today, and I know this is a policy response to an intellectual question, so I'll try and come to that in a second, but it is about persistence. So for all the reasons were implicit in the speech or explicit in the speech is we can't offset shocks to the price dynamics that pass through within a year, because by the time we've acted, they'll already be out of annual inflation and we'll be influencing the post-shock environment, and maybe we're actually going in the wrong direction there. So there's no kind of easy solution for high level of inflation today saying, well, let's just raise interest rates a lot, because by the time we get to the point where those interest rates are affecting the economy and affecting price developments, maybe we're in a different situation. So, recognizing that and seeing we have to have this calibrated, measured approach seems to me to be important. Now, of course, behind that is the view that the big spike in inflation now is a spike, right? And of course, there's two ways of thinking about that. One way is the way I tried to emphasize in the way I responded to Reece, which is to think through the economics of that. And that's probably the way I would favor, in the sense that we need to understand the behavior of the firms, the behavior of the wage bargainers and so forth that are actually setting prices. And we use the type of information from surveys and so forth. So in that sense. Now, of course, there is a question about, can we model that in a way that gives us definitive answers? I think we are in a different regime. That's my point about this transition. So maybe we need new models. Certainly, models estimated on the evidence of the last 15 years of very accommodative monetary policy may not be so appropriate. Arguably, models estimated on the data of the last 25 or 30 years, an environment where inflation wasn't subject to these big external shocks, at least of the magnitude we are seeing now, maybe that's not it. So, people say, well, you have to go back further, but the world of the oil price shock was a very different world in lots of other dimensions. So, I mean, I'm telling you your own business here, but, models are difficult things to do in trying to reflect structural changes in the economy. And behind that, I mean, there's a kind of question around, is the persistence of inflation something intrinsic to inflation itself, or is it something kind of more extrinsic and part of the economic behavior as a whole? And I guess the way we are thinking about, at least the way I'm thinking about it, is that we have to think more about the second. Because if it's the second, then that would suggest there's something we can do about it. We can try and stabilize longer-term inflation expectations, and we can act on the economy to try and cool off the labor market, if you like, to try and get the right amount of. So that's the way we are thinking about, I think, from a more policy-making point of view. If inflation is just intrinsically more persistent, I think there's a case for saying, well, our ability to steer inflation close to target on a day-to-day basis is going to be even more difficult. But the costs of not keeping inflation close to target are just going to be higher. So it's only adding to the reason why focus on price stability and so forth is so important. But I think you're right, and I know you were engaged with some of my colleagues, so I think we do need to try and develop these models. We need to have a scientific approach, and we need to use some of the data I mentioned earlier in my response to David. We need to think about how we can use that within a modeling framework to produce consistent results that we can evaluate over time. I think the question on mortgages is right. I think as a fact, you are correct. There are more fixed mortgages. There's also more scope to remortgage, so I don't think it's necessarily quite so clear in terms of how quickly the transmission takes place. And it also should be emphasized that the fact that there are more fixed mortgages means you've still got a lot of people who are about to come off mortgages they fixed, say, 5 years ago, that are now facing quite a big jump because the interest rate today is much higher than it was 5 years ago. So, the impact of this in terms of making things a little bit more, should we say, lumpy at the individual household level, even though potentially making it smoother at the aggregate level, I think that's something that we have to think carefully about, because we know mortgage debt, and indeed the impact of these real income shocks coming from higher energy prices, they vary a lot across in the cross-section of households, and particular by income. So, the squeeze on household incomes that we are seeing owing to higher energy and goods prices now, that's a squeeze that weighs much more heavily, as I think I said at the beginning of my remarks, much more heavily on lower income households, which maybe are less likely to have mortgages, than it does on higher income households, which are the ones that tend to have mortgages. Equally, the accumulated savings during the lockdown, they tend to accumulate at the better off households. The less well-off households haven't accumulated. So when we think about the sort of issue about how pass-through is going to work from monetary policy and from the shock that we're facing and how those two things will interact, I think it's very clear that we have to think carefully about that. But it's not, I think, as simple as saying it'll be faster or slower. I think it's a question of trying to understand the structures and the distributional effects within the household sector. And then, finally, to come to Rhys's point, I think my answer to that point is a little bit to sort of ask the question, how much do we know? And I think we should be quite humble about how much we know. How much do we have the ability, therefore, to fine-tune the economy with monetary policy actions? I think we should be humble about how much we have to do with that. So the question becomes, do you want to do these maybe smaller but slower, more persistent, more measured approach, which I think I would tend to favor on the grounds that ultimately the interest rates that matter for investment and spending and mortgage-taking decisions in the economy are more likely to be the sort of 2 to 5 year space than in the very short-term space. So if we get a reputation for jerking around bank rate very, very abruptly in the short term in response to all sorts of economic news, then financial markets will say, well, that's just all noise. And they won't pass that through into the 2 to 5 year segment, which is the one that matters for real transmission into the economy. So, I think there's like a general point that central banks have more leverage and more effective transmission of their policies if they're operating in this steady-handed, if you like, lower frequency way. And I think that has implications. Perhaps you're less focused on day-to-day news in the data. You're trying to extract more underlying trends in the data, because once you set policy on a moving path, it's probably going to be more persistent in moving in one direction. And I think that's kind of what we've seen at the Bank of England. And of course, it's not the only way. There is a more activist way. There is making bold moves, but one-off bold moves can also be disturbing in terms of their impact on financial markets. And I think we're yet to see the lasting impact. So, I mean, I do think there is a case for this more steady-handed approach.
Yes, I think I see it's George Selgin at the back. I think we'll just take that one question.
Yes, sir. You alluded to the fact that if the bank could have forecast all these shocks, the real shocks, then it would have taken action to keep the inflation rate on target all along. Some central bankers see merit in seeing through adverse supply shock-based inflation, at least to some extent. But you didn't refer to that as part of the Bank of England's strategy. Could you comment on whether, in fact, it is also part of the strategy? Thank you.
Yeah, that's a good question, and I think that does identify one part which perhaps was missing from what I said this morning. And so the short answer is we do take into account the character of the shock, and our remit given to us by the government, but which is embedded within our framework and our strategy necessarily, because it's the legal framework, if you like, in which we operate. That framework says getting inflation back to target, achieves primacy, price stability is the primary objective, etc. So there's a clear kind of hierarchy here. But it also says that in the face of those disturbances that create the sort of trade-off in the shorter term that I was discussing earlier, higher inflation now, but a weakness in the economy now, I think that's the type of trade-off, then there can be a case for operating in a more gradual way in order to not create unnecessary volatility in either activity or unemployment in the path back. So that's a story that says, yes, temporary supply shocks that induce these trade-offs, as long as they're not leading to more persistent movements in inflation through the second round effects, which would put the longer-term, medium-term reachievement, reattention of the inflation target at risk. I mean, there is scope to operate around that. Now, I would not, in current circumstances, overemphasize that as being core. And indeed, one of the messages I was trying to give today is, don't get caught up in thinking about the bank can do a lot to offset, these short-term movements in or shocks coming from the supply side. The core business of the bank, and in an environment we're facing now, where simple, direct, blunt, as I put it, messages are at their heart, the thing I would emphasize is it's the core message of getting inflation back to target. That is the core message and the core driver of our policy decisions. So we're going to do whatever is necessary to achieve that, but in the process of so doing, we are not blind to some of the supply type effects. If I could just say one other thing, if I just have a second on that. I mean, it's also true, of course, that when we talk about supply shocks, we're talking about you might want to look through temporary supply shocks. But if these supply shocks are permanent, if we're living because of geopolitical events or because of climate-related events or whatever, in a world where energy prices, and the UK as a net importer of energy, are permanently higher, other things equal, the UK economy or UK residents are permanently less well off. That's a real shock. That's something that monetary policymakers can't do anything about, right? Because monetary policy, in the end, all it can do is set the nominal environment in which the economy operates. And we're pinning down long-term inflation developments at target. That is our role, that is what we're doing. We can't offset, we can't unwind somehow this permanent real shock to the economy. And I think that's a very important thing to understand about where we are now, is that there is no easy solution in general, in fact, but certainly no easy solution that monetary policy can provide to the type of shocks that we are facing, because they are real shocks that do weigh on UK residents' incomes.